Hey guys, Toby Mathis here, and today we're going to go over 41 year-end tax strategies. So buckle in because we're going to go really fast because there's 41 of these. Okay, let's dive in. First off, I'm going to say top category, small businesses. Ready? Number one, if you have an LLC that is a single owner LLC disregarded for tax purposes, meaning that you are a sole proprietor and you are making anywhere north of $30,000 net, then you're going to want to consider making a retroactive S election on that. You can absolutely do that by the year end. Make a late S election. If you don't do it by the year end, there's something we can do under a revenue procedure that may allow us to still go back and get it. But you're going to save money on employment taxes if you are able to make that election before the end of the year. Number two, if you have an S election already, if you're an S-Corp, make sure that you run your salary before the end of the year. You got to run your salaries before year end if you have an S-Corp. And this is even more important because, number three, if you have a 401k, you can defer that compensation for federal income tax purposes. So if I pay myself, let's say $20,000 this year in my sole proprietorship or in my S-Corp, and I want to make sure that I don't have to pay tax on it, I'm going to push that into a 401k. If I'm an S-Corp, I'm deferring my salary. If I am a sole proprietor, I don't have a salary. So I just have to make sure that I get it set up before the end of the year. But I still get to have all these employment taxes on all my net income if I'm a sole proprietor. And I get about an increased audit risk of about 1,000% if I'm a sole proprietor. So I'm going to say, be an S-Corp, make that election before the end of the year, pay yourself before the end of the year, and defer a bunch of that into a 401k, and you're going to be really happy. Number four, make sure that you reimburse your accountable plan expenses. What do I mean? I mean things like your cell phone, your personal expenses that you incurred on behalf of the company. Make sure that the company is paying you back for those so the company gets an expense. Now, this requires that you be an S or a C Corp or an LLC taxed as an S Corp or C Corp, but you can reimburse those expenses and immediately get a deduction there. And as an individual, you don't have to report it because it's a reimbursement. So you don't have to report anything on your taxes, but you want to make sure that that is done before the end of the year. Number five, if you are buying equipment, and it could be a large vehicle, sometimes qualifies, gross vehicle weight over 6,000 pounds. It could be a pizza oven if you have your pizza shop. It could be any equipment that you need for your business, even a computer. Maybe you got 3 computers for your board of directors. If you incur that expense before the end of the year, it's an expense for the business in the year that it's incurred, even if it's on a credit card. So if you are going to be incurring some end of year expenses, even if it's on a credit card, make sure you do that. Number six, and this is for those of you who are S-Corps or C-Corps or LLCs taxed or S or C, make sure that you have your holiday party before the end of the year. And when I say a holiday party, I mean a holiday board meeting where you are getting together and making your end of year decisions. In fact, watching this video wouldn't be a bad idea. And then you can cover and reimburse yourself for things like 280A, the Augusta rule, where you're using your home for the benefit of the business as long as it's less than 15 days a year, 14 days or less. You don't have to report that income. The business gets an expense based on the fair market value of that accommodation. So you can go call some other hotels. I always suggest people do 3 and see, hey, how much would it cost me to have a boardroom and access to the internet so I could do a end of year board meeting / holiday party, things like that. Make sure that you do use your 288 before the year end because it is 14 days per year and it's calendar year. So if you've used it 10 days, you have 4 more days that you could potentially use it so long as it's reasonably necessary for the business to have those meetings. And a board meeting, you always got to have because it's statutory, right? But if you want to have, for example, hey, let's do a watch party and we're going to do a virtual event. Maybe you're going to do one of the cash flow summits that Alpine does as part of our Infinity program. It's 3 days. So there's 3 days. How much can I reimburse? Whatever it would cost you to use somebody else's accommodation. So you call the local hotel. If they said, hey, it's $750 a day for internet and a nice room for 3 or 4 people, plus refreshments, whatever, great. Then I can get $750 a day, tax deductible to the business, tax-free to me under 280A subsection G2. Number 8, Make sure that you pay yourself for your administrative office for the year. Now, this is similar to a home office, but it's an administrative office for you in a company like a C or an S-Corp. This is not for sole proprietors. If you have an administrative office in the home where you're doing your management activity, your administrative activities on behalf of the company, which is like just about everybody that I know that does real estate and things like that, you're operating out of your home, not out of an office facility, you can reimburse the percentage of all the expenses associated with your home that room or that space is taking up. So I'm not going to get too much into details. I have a lot of videos on these things. But you want to make sure that that expense is paid before the end of the year because it's deductible to the company and it is not taxable to you. All right, let's jump to number 9, buying a new vehicle before the end of the year. And let me explain how this works. So there's different ways you can get a tax benefit from a vehicle. My personal favorite, and this is going to tick off a whole bunch of you practitioners out there, is just to do a reimbursement of the mileage. Every year they're putting it out. It's right around, I think it's what, 67 and a half cents per mile. Just track your business miles on your car. It's the easiest. It doesn't mess with your insurance or other things. But if you are in a business that needs equipment or needs a vehicle that is not a typical passenger vehicle, like maybe a van or things like that, maybe something to haul things with, where it's got like a really long bed on it and it's a heavy vehicle, then just buying it and putting it into service gives you a massive tax deduction before the end of the year. All over the internet is bad information, by the way. It's like they'll go out there and say, oh, buy a vehicle with a 6,000 gross vehicle weight or higher, and you can write the whole thing off. All you have to do is buy it before the end of the year. No. Number 1, your vehicle's depreciation is restricted under the code if it is a passenger vehicle. I'll just call that a light vehicle. If it's a light vehicle, you have a limitation of the maximum amount. It's about $20,000 a year that you're going to get to write off. It's not going to qualify as equipment under Section 179, and it is not really going to give you much of a benefit under 168K, which is bonus depreciation. So first off, get it out of your head that you can just go out and get a vehicle and write the whole thing off. If you do have a vehicle that qualifies under 179 with $6,000 or 6,000 pounds or greater gross vehicle weight, I'll call that heavy vehicle. If it is like an SUV or something, they're still going to give you a limitation. It's right around, I think it's $30,500 max deduction first year. Now, in both of those, you have to track what your business mileage is. You got to track using like an app like Mile IQ or something, and you got to track what percentage is business use. In order for you to qualify for a Section 179 deduction, it's got to be more than 50% business use. And it has to be for its entire life of that vehicle. That vehicle's useful life is 5 years. So typically, you're writing off your vehicle over a period of 5 years. With these limitations, they limit how much you can write off in any particular year. So you end up with a little bit of a higher deduction in year 1, maybe decent in year 2, and then it starts dropping. That entire time, you have to make sure that you are using that vehicle primarily for business. If you take that 179 deduction, that $30,500 as an extra amount, plus you depreciate it. So you get to use both. You get to use all of these in conjunction. But if you do, here's the string that's attached to it. If you fall below the 50% of business usage, the entirety of whatever you deducted underneath Section 179 is taxable back to you as though you just paid yourself that money. And you're going to have a taxable event called recapture for the amount that you deducted. Making your head spin yet? Then you have equipment that is greater than 6,000 gross vehicle weight, plus it's not used for hauling around passengers. You think of like your trucks that are made for a specific usage. I mean, I always think like a mail truck or a UPS truck or things like that. You can't use it for anything else. You could write that one off 100% in the first year. But same thing, if you drop below the 50% business usage, recapture at your ordinary tax rate. And when you sell it, you get recapture at your ordinary rate. So you understand now maybe why you're hearing me say, hey, just do the mileage reimbursement, because we don't have any of that nonsense. We have to do all that recapture. But If you are one of those businesses and you really do need a heavy vehicle and you finance it or you do something, as long as you buy it and put it into service, and it'll be great if it's 100% business use. Like, hey, you're one of those people that just has to go get that G-Wagon, and you think you're not going to get to write the whole thing off. But let's just say that you went out there and got that G-Wagon. You're going to get a $30,000 bonus under 179 in that first year. Plus, you're going to get to depreciate it. But make sure that you're using 100% for business, and better yet, get a personal vehicle and have a business vehicle. Keep them separate. If you're doing that, though, you got to stick with it. You can't go back and forth and say, I'm going to do mileage next year. Once you start doing it, it's called the actual expense method. You are stuck using that. Just want to make sure that's clear. And no matter what, you still have to track your mileage. So that's a huge benefit. But boy, is it ever misunderstood. I hear people all day long sitting there saying, oh, you can write off 100%, get a G-Wagon, get a big SUV. This. No, you cannot do that. Make sure you're talking to your tax professional. But they are right. If you put equipment into service before the end of the year, even if you use it for a week, you can write it off under 179 entirety in that year, so long as it qualifies. And here's the disqualifier: light passenger, and then even some heavy passenger, the ones that are over 6,000 gross vehicle weight, but they're a passenger vehicle that could be used for other things. And then if you are using it personally, let's say you're using it 80% of business for business, 20% you lose of whatever that deduction was, you would lose. So if you had a $30,000 deduction, you're going to lose 20% of it, or what is that? So you'd get a $24,000 deduction if 80% was used for business. I just want to be clear on that because there's so much bad information out there. You never buy a vehicle for the tax write-off, but if you are going to buy a vehicle and it does qualify, putting it into service before the end of the year could be a great tax break. And that was which one was that? That was number 9. Number 10, if you have kids under the age of 18 and you're a sole proprietorship or a partnership, and people just said, well, I thought you didn't like the sole proprietors. If you're less than $30,000 a year, I'm not adverse. If it's over $30,000, it makes sense to have that S-Corp. But if it is you, let's say you have real estate and you're operating as a partnership, your holding company, you pay your kids under 18. You can pay them without having to do withholding for Social Security taxes. And most of the time they're exempt from withholding, period, because they've never been paid before, because they get paid so little in the past. So you could have no withholdings, pay your kids. Why would you do that? Because if they're below the standard deduction, their tax rate is 0. So if you could pay your kids and get that money off of your income sheet and onto theirs where they are at 0 and yours might be, 30% plus, that's a nice tax savings. If you do that before the end of the year, make sure that you pay those kids before the end of the year. And then if you say, wait a second, what about my friends? What about my brothers and sisters? Maybe it's the grandkids I want to help. Okay, I'll show you how to do it. The same rule applies. If they're a sole proprietor and they pay money to their kids and they're under 18, then they don't have to do all the withholding and the reporting. So what is a benefit is if you pay their sole proprietorship. So, hey, I pay my brother's sole proprietorship. He pays his kids and gets to 0. Fantastic. There's no tax owed. And they got the money over to the kids tax-free. I got a deduction for it. Everybody wins. That's how that works. So do that before the end of the year. And then if you have other folks that you have to pay, make sure that you are paying them out before the end of the year. Most people are going to be a cash basis taxpayer, meaning that it's when you write that check is when it's deductible. So if you are paying people payroll or 1099 and you don't pay them until January, and you're sitting here, let's say it was a $10,000 bill, that $10,000 is showing up on your income statement this year, and you're going to get a deduction next year. We want that deduction right now. We're going to pay it before the year end. And if you are paying, again, if you have kids that are over the age of 18, or you have siblings or other things, you can always pay them either as a W-2 if you have control over them and they're an employee, or if you're just using them for contract work, you can 1099 them. Just make sure you pay them before the end of the year. Their tax situation is their tax situation. They're going to use their expenses to try to whittle that down and pay tax on what's left. Hopefully they can get it down to zero, but the idea is that you're paying them before the year is out. If you do not want vendors to pay you before the end of the year because you had a really great year and you're like, man, I'm getting killed in taxes, you can always say, hey, have a grace period. Don't pay me till after January 1st. Why would you do that? Because you pay tax on the receipt of those funds if you're a cash basis taxpayer, which we almost all of us are. So if I can get vendors to say, hey, give them a little holiday, don't pay me this year, they're not getting the deduction this year, but you're not getting that income this year. They pay you in January, then you just give yourself another 12 months to pay the tax. If you want the income and you're like, oh man, I want to fund my 401k, or I have a DB plan, or I have other expenses I want to fund and I need the cash, give them an incentive to pay you early, even on their January stuff, and say, hey, if you want to pay ahead of time, you certainly can. I want to have that money come in now and recognize it this year. By all means, do that. If you have things like computers or other tech that you need to pay, or that you want to have, that you know you're going to be getting in the next year anyway, buy it now, buy it on a credit card, buy it on financing, buy it like pay as you go, whatever it is. Get it before the end of the year, put it into service before the end of the year, because it's deductible immediately before the end of the year, so long as you purchase it and put it in service. How about next one, 16, is get a 1099 plan in place. You're going to have to issue 1099s to anybody that you paid more than $600 to next year in January. So make sure that now, before the end of the year, you're starting to come up with a plan as to how you're going to do that. It might be that you're talking to your bookkeeper. It might be that you're just making sure that you have all the W-9s. You know, everybody that you're supposed to be paying, make sure that you have the right paperwork so you can 1099, because it becomes really annoying in January if you're running around trying to get information and people aren't responsive. It's after the holidays or whatever. And all of a sudden you're like, shoot, I have to get this done. I have a hard deadline. End of January, I got to get that out to people. Yeah, let's make sure that we're thinking about it now. Number 17, and this is one that is still on the dirty dozen list of the IRS, so, but it works, but it gets abused, and that is captive insurance. You can put over, I think it's $2.4 million this year tax deductible to self-insure uninsurable risk. If you are a high income taxpayer, if you have a business that is doing very, very well, then things like what happened during COVID, shutdown risk, mediation, self-insure, like a lot of dentists, things like that. If you have a problem with any of the work you did, you're fixing it. Here, you're putting money aside to make a claim against yourself, essentially to get that done, but you get the deduction now. So you can create a little war chest with that captive insurance, but it works like a charm, really creates a nice little stockpile so that if things pop up, you can take care of it. Okay, individuals. So that was small business. Now let's jump into individuals. These are tax deduction things that you could do before the end of the year that will have an impact and lower your taxes for this year. How about this? Open up a business, make a sale. Like, get it going, get that business operating, get that business to where it's actually an operating trader business so you can take deductions for all the expenses that you used to start it up. Especially if you have something that you've been working on for a while and you have expenses. You can't deduct them yet, but we can grab startup expenses up to $5,000, organization expenses up to $5,000, but you got to have an operating business. So get that business, kick yourself in the butt, get something going so that that business starts this year, so all those expenses become immediately deductible this year. That's actually really important. Number 2, and I'll call this, that's actually number 19 when we're keeping a track. It's like, I think I had 41 of these things. Open and fund an HSA. Health savings account. If you have a high deductible plan, which we almost all do, check it out, get an HSA, put money into that HSA before the end of the year, or at least adopt it before the end of the year. You can actually fund it up until April of next year, but you get a tax deduction now, but you got to have it in place. You got to get that plan in place. We want to adopt it if humanly possible this year, and it's even better if you say January 1st, but you got to make your reimbursements out of it before 12/31. Now, you can only reimburse from the time that it's enacted, and you incur expenses beyond that. So keep that in mind. But you want to get that HSA set up as soon as humanly possible so you can dump money into it HSAs are powerful because you get a tax deduction, you get tax-free growth, and so long as it's used for health expenses, you don't pay any tax. So you get a deduction with no tax in the future. So it's better than a Roth. It's like a Roth on steroids. And if you get stuck with too much money in it, if you have too much money in that HSA, when you hit 65, they treat it like a traditional old IRA. You're going to pay tax as it comes out. Number 20, if you have a business that you're not using anymore, dissolve that sucker. Let's get every expense associated with it into this tax year so that we're getting the benefit out of it. Also, just do some cleanup. Do you have businesses that are floating around out there that you're just continuing to carry on because you don't know what to do with, or maybe they did some activity in the past? It's time to consider dumping them, taking that expense now. FSA. So these aren't my favorite. You got to have an employer that allows it, number one. And number two, you have a use it or lose it provision. Make sure that you use whatever amount it is that you would lose if you didn't make those, pay for those or cover expenses during the taxable year. So there's usually a small portion that will carry forward that, but in the rest of it you lose. Make sure that you're using up the use it or lose it part if you have an HSA. Again, not my particular favorite. Number 22, if you have kids that are greater than 18 years old and they are making wages, even if it's some other business, I strongly consider you to do a Roth IRA, especially if they are in the lower income categories, because they will never pay tax on that growth. They'll never pay tax on any of that income that comes out of it if they do it right. And they have earned income so they can fund it. Even if you have to gift them money so that they can cover their other expenses and continue to live, if they made at least $7,000, have them dump it, please, into that Roth. And if they made more than that, if they're actually doing really, really well, then talk to them about doing a traditional IRA or something that will give them a little tax deduction. Again, so long as they made the money, they can contribute. Even if you gift them money and say, hey, this is so you're able to contribute, make sure that you're doing it. You know, you can't contribute for them. They need to contribute money that they earned, but they can live off of the gifted money and contribute the other. If you are going to do, number 23, a conversion of a traditional account, 401k or IRA, into a Roth IRA, if you're going to consider doing that conversion, you got to convert by 12/31. When should you convert? If your taxes are lower now than you expect them to be when you retire, then you should be doing a conversion into a Roth. If your tax bracket is higher now than what you think you're going to be when you retire, then it's probably not worth it. Talk to somebody, crunch the numbers, because a lot of people convert when they're in those highest brackets and it takes them 40, 50 years to make up the tax hit. So before you just blindly do something, have somebody calculate it. Number 24, if you're going to make charitable contributions, especially if you're itemizing and you know you're going to be using Schedule A, make those contributions before the end of the year. Use a credit card if you have to. Write the check. Whatever you have to do, get that thing paid before the end of the year. If you are required to do, if you have an IRA and you have a requirement to do RMDs, required minimum distributions, and you'd rather just direct some of that money into a charity, I think you do $100,000 a year, then it goes straight to the charity. It's no longer taxable to you. So you can avoid having to pay tax on the required minimum distributions. You can absolutely do that. And then last one on the charitable side is if you have appreciated assets. So if I have real estate, stocks, or something that has gain in it, hey, I've owned this stock forever, it's 90% gain and it's worth $200 a share, donate those shares. You get a tax deduction based on the fair market value. It's pretty nice, and you don't have to pay tax on it. So if you're going to do charitable giving, just make sure you do it by the end of the year. If you are going to be a real estate professional, or if you are doing short-term rentals and you're doing Airbnbs, buy a property before the end of the year, put it in service. You can accelerate depreciation and take that bonus this year. So there's certain types of things. People are used to hearing 27 and a half years or 39 years to depreciate things. When it's 5, 7, or 15-year property, you can accelerate a bunch of that. This year it's 60% into the first year. Even if it was only in service for a week, does not matter. Get that into service, write it off now so you get that deduction now, even if you finance the property. So if you are a real estate professional, if you are doing the short-term rental, if you are doing self-rental, even, hey, I'm putting it into service and I'm renting it, hey, I'm buying my own pizza shop, I'm buying the real estate to put it in, put it there. If I could put that into service, if I can get some income coming in off of those things and put it in service, make sure that business is active, then I can group those two activities and I can end up with a nice taxable loss that I could use against my other income. Number 26, quarterly deposits. Make sure that you are doing your quarterly deposits. You have another one coming up in January, but take a look at what you've done during the year. And there is possibility that even if you don't owe taxes at the end of the year, you could owe taxes on improperly paying your quarterly taxes, being too late. There is a possibility, if there's unequal income, to make it up before the end of the year, especially on salaries and things like that. You can make sure that you do a makeup before 12/31 on your running through payroll and allocating it towards your withholdings, and that might get you out of some problems. Number 27, oil and gas. Intangible drilling costs is a ordinary deduction. It offsets your W-2 and other types of income. Oil and gas could be a really nice tax savings, but you got to invest and it's got to start the digging, the drilling within 90 days of the end of the year. So you got to make sure that as you're coming into the end of the year, if you're doing oil and gas, you got to have a little conversation to make sure that you're going to qualify to get that deduction this year. But boy, is it potent when you do. Those are a great one. Things like your employment taxes. So the 329, I should say employment taxes, but the college savings plans and things like that. You got your Coverdell and you got your 529 plans, especially the state plans. Make sure that you're making those contributions before the end of the year. Make sure that they fall into the right category. How about 29? Use capital losses. So if I have any capital losses, will offset capital gain. So I want to look around and see if I have unrealized capital gains, if I have realized capital losses. And I want to see if I can wipe out some of those capital gains with those capital losses. So if I'm sitting there with a whole bunch of capital loss and I know that I can, hey, I've done well on some things, marry them up so that we're not having any tax on it. You don't lose the capital loss, by the way. You don't lose it, it carries forward. But if I need the money now and if I've been holding back because of a tax situation, make sure you can marry them up so that you don't get hit with some unnecessary taxes. The other thing you want to look at is, for example, married filing jointly. If you are below $96,000, you're in the 0% long-term capital gains category. So if you have stocks that have gone up in value, and let's just say that you've made $60,000 of adjustable gross income during the year, and you're thinking, okay, I have about $20,000 of unrealized long-term capital gains. I'm going to tell you, sell those stocks and buy them right back. Why? Because I have $20,000 that's going to hit my tax return that is tax-free. I'm in the 0% long-term capital gains category there if I'm married filing jointly. And then I buy them back and the basis resets. So even if I do that really quick, hey, I immediately sell them. As soon as those clear, I buy them right back. And you look at it and go, Toby, why the heck would I do that? Because you'll never pay tax on any of that gain. If you were paying tax at 15%, 20%, whatever in the future, you're going to be thanking me that we just reset the basis to that new value. It's tax-free money. I may as well recognize it this year. And yeah, I have a little more income on my return, but a big chunk of it is zero. So I'm okay with that. And now my basis in those stocks is higher so that if it continues to appreciate in the future, I'm not getting hit with a big tax. So there's always that type of analysis that you can do. Some of you guys are immediately saying, but what about the wash sale rule, Toby? You can't do that. You can't sell a stock and then buy it back. Yes, you can. There's no wash sale gain rule, the wash sale loss rule, and there's a workaround. So if you have losses that you want to harvest, that would be number 30. you could still do that. And here's how you do that. You sell the stock, boom, you have a loss. Buy an in-the-money option. That negates the loss, and the loss attaches to those options, the basis of those options. Then buy back the shares. Okay, so now I own the shares again. You're saying, well, there's the wash sale rule. They've already attached to the option. Now sell the option, and that loss will make a greater loss on those options. So those options, if you bought in the money, they won't move. So you just have the loss from the first sale of stock, and now you have the capital loss that you were trying to get in the first place. And you get to keep it, and you own the shares. That's the workaround. So if you want to get around that wash sale rule, that's how you do it. Because once you buy a replacement stock, the loss attaches to it. So if I have ABC, I sell it, I buy an in-the-money ABC option, and I sell it at a loss, and then I buy the ABC option, and in the money, that loss attaches to those basis of those shares. So now I'll have automatically that loss is now on those options. I haven't sold them yet. So then I buy the shares of the company back. So now I own the shares and I own the options. So when I sell the options, those losses are released. Voila, I get my losses. If you are high appreciation, then 31 might be the strategy for you, and that is to use a charitable remainder trust. Now, I think we probably set up a handful every year. They're not appropriate for everybody, but if you are thinking, I have high income or highly appreciated assets, if I sell them, I'm going to have tax, and I'm willing to spread out some of that tax hit over a lot of years, and I want to benefit charity, boom, it might be something that is advisable for you to do. Crunch the numbers. You can absolutely reach out. And by the way, if you want us to talk to you about any of these, just go into the comments and put strategy in the comments. We'll send you a link for getting a consult so you can determine whether or not any of this makes sense for you before the end of the year. There's also, I'll put a strategy link in the show notes so you can go there. The easiest thing, though, is just in the comments. Just go in there and just type in strategy. Number 32. All right, let's calculate our Schedule A. What is our mortgage interest that we're going to get to deduct? What is our charitable giving? What about our state and local taxes? Are there limitations? What about our medical? If you are usually right up against the standard deduction, then I'm going to suggest you might do something called getting lumpy, which means to, instead of paying them in each year, at the end of the year, prepay a bunch of stuff that you would normally be giving. Let's say you do charitable giving, and you're like, normally I give a bunch of money every month. Prepay for next year, even if it's on a credit card, because I get the deduction when I make the contribution. So maybe I do that so that I'm far above my standard deduction and I don't lose all the benefit of that. And then I just don't make all those contributions next year. So instead of writing them off and getting no benefit over 2 years, year one I get almost no benefit, year two I get no benefit, year one I get big benefit, year two I get no benefit, because the standard deduction is still going to get me a benefit. What it'll end up doing is just putting back some more money in your pocket. And if you're doing financing or things like that, it should just be way more than the financing, right? We want to crunch the numbers and see if it's going to benefit you. But if you're one of those folks that tithes and you're making those payments anyway, it might be wise for you to say, hey, you know what? I'm going to finance my charitable giving next year, do it this year so I put it on a credit card or use a line of credit or whatever. I'm going to do it now so I get the deduction now. How about solar, EV, electric vehicles? Buy them, put them into service before the end of the year, or at least start like on solar. I got to make steps towards putting it up on my roof. It's a 30% tax credit. So even if I finance it, again, hey, I'm going to put a $30,000 unit on my roof, and I can get that put into play this year, I'm going to get a $10,000 tax credit. It makes it a lot cheaper. Even if I'm financing the 30, I didn't even come out of pocket, I'm going to put $10,000 in my pocket. And of course, the savings on my electric bill will help pay for it over time. So that is a wise tax play. Or if you have an electric vehicle, make sure you do it before the end of the year, put it in place, just make sure that it qualifies. There's all sorts of new rules. Last thing on the individual side is if you need money. So I'm going to give you a scenario. Hey, I really need money for Christmas travel, or I need to do a trip. I need $10,000 bucks. Hey, I have some stock that I'm going to sell. I'm going to liquidate and I'll pay the tax on it, and then I'll use what's left to cover that $10,000. Don't do that. See if you could borrow or use, like maybe I use the stock and I just get a line of credit against it, and then I'll pay it over time. I don't have to pay tax when I do that. So borrowing is tax-free. Maybe you have an index universal life. Maybe you have a whole life policy. Maybe you have a HELOC on a house. Whatever the case, if you sell something at a gain or a taxable event and you have to pay tax, it kind of takes away the benefit there, right? Like, let's see if we can hold on to our assets and borrow instead, because borrowing is never taxable. When we borrow, we get to do it right in before. All right, real estate. These are our last few. If you're a real estate investor, this is for you. Number one, which is number 35 on our total list, make sure that you put your properties into service before the year end. Make sure that you get them into service so we can start the depreciation process, especially if you're short-term rental, real estate pro, you're going to do a cost seg, you're going to accelerate the depreciation. If I put a property, say I put a $300,000 property, let's say the land value is nominal, let's say it's $25,000, I have $275,000 of depreciable basis, and I want to see about getting a big tax deduction this year. I get to cost seg it, which means I break it into 5, 7, 15-year property along with its 27.5-year, but it's usually about 30 to 40% of the property. Let's just say it's 30%. What would that get us to be? Right around 81,000 or something like that. So I have $81,000 of short-term assets. Of that 81,000, I would get to write off, let's see, 60% of that. So I would get a $48,000 immediate tax deduction, even if it was put into service in December. It doesn't matter. As long as it's put into service before the end of the year, I get that tax deduction now. And if I'm a real estate professional, short-term rentals, things like that, it could offset my W-2 income. Depends on what bracket I'm sitting in, but that might save me some serious money on my taxes by doing that before the end of the year. Number 36, track your real estate professional hours. Please do that. It's 750 hours and more than 50% of your personal service time. And then make sure that you meet material participation, which is, generally speaking, it's going to be the 100-hour test. The first one, real estate professional, one spouse has to meet if you're married. The second one, you guys combined your time. But you want to make sure that you are tracking those hours and that you're keeping a log and that as close proximity as possible. So if you haven't been tracking well, go back through your records, get a little Excel spreadsheet, get your phone out, get your calendar, remake those so that it's as close to the date that you did it as possible. You'll thank me if you're ever audited, because that's actually a thing. If you are an active participation, which means you manage the manager, and you qualify for that $25,000 loss on passive losses. So if you're a real estate investor and you are below $150,000 of adjusted gross income, this active participation may be a thing that actually helps you. If you don't know what it is, again, reach out, just put strategy down below. We'll explain it to you to see if it actually benefits you. But if you, especially if you're like at $100,000, because you're definitely below the phase out period and you have passive losses that you've never thought you could write off, you could actually write off up to $25,000. So it might save you, $5,000, $6,000, whatever you're, based on your taxes. Short-term rental strategy. This is a big one. If you have an Airbnb or VRBO or a property, and the average use every time you have a guest come in is 7 days or less. So it rents 7 days or less on average. You are no longer a rental passive activity. It's no longer an investment activity. You are a hotel. You are an active trader business. And as such, those losses could be non-passive if you materially participate. I know I just threw a lot at you. It just means that if you're an Airbnb or VRBO, or if you're doing that type of activity, self-renting, and you're doing short-term, and it's the average is 7 days or less. So you take the total number of days that you rented it during the year and you subtract it by the total number of unique rentals or guests. I guess a guest could come back twice. So it's unique rental. So each time that somebody comes in and uses it, divide it. So if you had 20 different people come in and you rented your property for 100 days, then 100 divided by 20 is 5. You are not a passive rental activity. You are a trader business, period. And the only question is, did you materially participate in that trader business? It's a great way to unlock some losses, especially for high income folks. Especially, I have a bunch of doctors that do this. They always buy short-term rentals at the end of the year. Their families operate the short-term rental. They accelerate the depreciation. They take the bonus depreciation, and so we're doing a cost seg and bonus depreciation, and they get a huge tax savings at their tax rates. It's usually so high. They're just happy as heck because they get all this tax benefit, and it helps them finance and buy more of these properties, right? They're able to use it as the down payment. All right. Pay for your repairs before the end of the year. So if you're a real estate investor and you have repair work that needs to get done, make sure you're paying for it before December 31st. There's 3 ways. There's a safe harbor. If it's less than $2,500, that's the easiest one to remember. Then it's always a repair. You can safe harbor it. You just make an election on your tax return, or your preparer would do that. If it's routine maintenance, in other words, something you expect to do more than twice during its useful life, you can write it off as a repair. And if you are a small taxpayer, which is, I'm not going to get into all of it, it's $10,000 or 2%, but it's less than $1 million of depreciable basis, then you can qualify. The one I see all the time is that safe harbor, the $2,500. If you keep financials for non-tax reasons, so like you have a loan or something like that, then it's $5,000. It actually jumps up. But just remember that there's a safe harbor. Make those repairs before the end of the year. Know this, number 40, rents are taxable when received. If you are in a position where you have too much income and you don't want it, then say to your tenants, week-long holiday, 3-week holiday, whatever it is, pay me December's payment in January. Just double up January. Happy holidays, if you wanted to do that. Now, it's up to you. Some of you guys are going to say, well, maybe they don't pay me, right? But if it's when they pay the rent, it's when they pay. And then also for you, if that's an expense for you, it's when you pay the rent. So if you want to pay January's rent in December and incur a better deduction in December, you can do that. So as long as it's an expense that's going to be fulfilled in the next 12 months, you can do it. You can't prepay everything, but you can certainly get you a little extra month. And then 41, last one, we just busted through a bunch. I know you guys get a star for sticking through to the end. Installment sales. If you're selling property, if you're selling an asset, and you want to stretch it out over different tax years, you can do that. It's Section 453, and it's when you are taking payments over more than one taxable year. So, for example, if you're selling a property in December, you might want to say, pay half now, pay half in January. And you're like, well, why the heck would I do that? Because half of the sale is taxable this year, half of the sale is taxable next year. I don't know what your gain looks like. I don't know what your tax situation looks like. But sometimes that's the difference between somebody staying in the 15% tax bracket versus being in the 20% with the net investment income tax of 3.8% on top of it. It could save you 8 or 9% on that tax. So it does have an impact. Now, if I made your head spin, strategy in the comments, meet with somebody, have them talk to you, or better yet, start hanging out with us, subscribe to this channel, start watching all the videos, because you're going to get a ton of detail on each of these ideas in those different videos. You can kind of look them up and I think there's over 900 videos on this channel at this point. You could always come to Tax Tuesdays too. If you don't see, we do a live cast every other week where we answer all your tax questions live. That's a great place to go. Ask a bunch of questions. We have a bunch of attorneys, CPAs, EAs, and other accountants on at those events, and we don't charge for that. You could absolutely pop in. So do that, like and subscribe, and if you want a strategy session, just type in strategy in the comments and we'll send you that link. Thanks, guys.